Did you know that Warren Buffett bought his first stock at just 11 years old and regretted starting too late? He's now worth over $100 billion, making him one of the richest people on earth, not just from his savvy investment choices but also through his remarkable approach to life and business. In this video, we'll explore not just what makes Buffett tick, but how his straightforward yet profound investment principles can be applied by anyone, anywhere. From understanding the real value of a company to knowing why diversification might not always be the smart move, we've distilled Buffett's wisdom into 10 essential rules. Stay tuned as we break down these principles, peppered with quotes from the man himself and real-life applications, to help you think, invest, and maybe even earn like Buffett. If you're ready to transform your approach to investing, this journey through Buffett's rules is your starting point. Chapter 1. The Principle of Value Investing. Warren Buffett is synonymous with value investing, a method where investors look for securities priced below their intrinsic values. But how does one determine intrinsic value? It's not just about low prices, it's about finding robust companies at a good price. Buffett often emphasizes the importance of looking at the long-term potential of a business and not getting distracted by the market's day-to-day fluctuations. Here's an interesting fact. Buffett's approach was heavily influenced by Benjamin Graham, his college professor and the author of The Intelligent Investor. Graham taught Buffett to treat stock purchasing like buying a business. This means examining financial statements, understanding the business model, and considering the company's leadership before buying a share. Chapter 2. Buy and hold. If there's one strategy that's quintessentially Buffett, it's the buy and hold approach. But why hold on for years, even decades? Buffett believes that if you wouldn't feel comfortable holding a stock for 10 years, you shouldn't even think about owning it for 10 minutes. Patience is more than a virtue in investing, it's a strategy. Buffett once said, "Our favorite holding period is forever." This highlights his focus on finding companies so good that you never want to sell them. He's held on to stocks like Coca-Cola and American Express for decades because their long-term value and steady dividends make them worth the wait. Holding long-term reduces the urge to act on every market hiccup, stabilizes your portfolio, and can significantly decrease trading costs and taxes. Moreover, it's a testament to Buffett's confidence in his choices and his disdain for following market trends. Chapter 3. Circle of Competence. Warren Buffett advises investors to stick to their circle of competence, the areas they know best. It's not about how big this circle is, but how well you define its boundaries. By investing in industries you understand, you can better judge potential risks and opportunities. Buffett credits much of his success to staying within his circle, which primarily includes insurance, consumer goods, and financial services. For instance, despite the tech boom, Buffett famously steered clear of technology companies for decades because he didn't understand their business models. This changed only recently with substantial investments in companies like Apple, showcasing that even within your circle, there's room to learn and grow. Chapter 4. Economic Moat. An economic moat is a sustainable competitive advantage that a company possesses that makes it difficult for competitors to wear down its market share. Buffett often invests in businesses with a strong moat because they can fend off competition and earn high returns on capital for many years. Examples from Buffett's portfolio include Coca-Cola with its brand identity and Apple with its ecosystem of products and services. Buffett's ability to identify companies with durable moats allows him to invest with a long-term perspective, ensuring steady, reliable growth. This principle is central to understanding why some companies are worth paying a premium for. In Buffett's own words, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Chapter 5. Risk versus Reward. Warren Buffett's ability to weigh risk versus reward is a cornerstone of his investment success. He often speaks about the difference between perceived risk and actual risk, emphasizing that a well-understood business is often less risky than one might think. This perception is backed by thorough analysis and understanding, rather than market sentiment. Buffett's investments are not about avoiding risk but about understanding it deeply and managing it effectively. For instance, Buffett's significant investment in railroads, specifically BNSF Railway, was seen as risky during the economic downturns. However, his understanding of the essential role railroads play in the American economy and their efficiency over long distances compared to other forms of transport indicated a lower long-term risk. This move exemplifies how Buffett's decisions are based on intrinsic business value and long-term profitability rather than short-term fluctuations. Chapter 6. The Market is Emotional. Buffett often describes the stock market as a manic depressive who swings from unchecked optimism to baseless pessimism. He argues that investors should be fearful when others are greedy and greedy when others are fearful. This perspective allows him to exploit market volatility by buying undervalued stocks during downturns and holding or selling when the market is high. One of Buffett's most famous applications of this principle came during the 2008 financial crisis. When most were selling off their holdings in a panic, Buffett was buying, most notably, his strategic investments in companies like Goldman Sachs and General Electric. He provided them with much-needed capital, securing lucrative terms for Berkshire Hathaway in return. Chapter 7. Avoid debt. Warren Buffett is known for his cautious approach towards debt. He advises investors to avoid companies burdened with excessive debt because it can limit their flexibility and resilience in tough times. Buffett's emphasis on having ample cash reserves and avoiding high leverage is particularly pertinent. This principle is not just about avoiding risk, it's about maintaining enough freedom to capitalize on opportunities as they arise. Buffett's Berkshire Hathaway often holds substantial cash reserves, which allows the company to make significant investments when others might be constrained by lack of funds. For example, during the 2008 financial crisis, while other companies were struggling to manage their debt, Berkshire Hathaway used its strong cash position to buy valuable assets at a discount. Chapter 8. Reinvest profits. The power of compounding is a fundamental element in Buffett's strategy. He believes strongly in reinvesting profits to generate even greater returns over time. This reinvestment can take the form of buying more shares of a company, improving business operations, or acquiring new businesses. The key is to ensure that the reinvested funds are employed at high rates of return. Buffett's own history provides the best illustration of this principle. By continually reinvesting profits from his initial textile business into more lucrative industries, such as insurance, and later into owning companies outright, Buffett was able to grow Berkshire Hathaway's capital exponentially. He often talks about the snowball effect, where small gains accumulate into massive wealth over time. Chapter 9. Diversification isn't always required. Warren Buffett has a somewhat controversial take on diversification. He often quips, diversification is a protection against ignorance. Buffett believes that for knowledgeable investors, diversification is not necessary. Instead, he advocates for a concentrated portfolio of investments that one understands deeply and believes in strongly. This approach is predicated on the idea that a well-researched, concentrated investment can yield significantly higher returns than spreading one's investments too thinly. For instance, rather than diversifying across hundreds of stocks, Buffett prefers to bet heavily on companies he trusts and understands profoundly, like Apple, Bank of America, and Coca-Cola. This strategy relies on the investor's confidence in their picks and their ability to endure the market's volatility without panic selling. Chapter 10. Philanthropy and Ethics. Warren Buffett's investment philosophy extends beyond just making money. It also encompasses using wealth responsibly. He is a prominent proponent of ethical investing and has pledged to give away the vast majority of his fortune to philanthropic causes, primarily through the Gates Foundation. His actions underscore a belief in the accountability of the wealthy to society, and he champions the idea that investors should not only seek to maximize returns but also consider the social impact of their investments. Buffett's approach to ethics in business and investing is integral to his method. He chooses companies that not only perform well financially but also contribute positively to society. His stance on philanthropy has inspired many other wealthy individuals to pledge significant portions of their wealth to charity.